So welcome back to session 42. Here we're going to talk about technical analysis as an investment strategy. This is a very controversial chapter. I will not try to force any position, let's say from the academic standpoint, is usually looked down. But from the practitioner standpoint, technical analysis is usually a very useful tool that allows investors or traders to get a sense of where the market is, what the market sentiment is in general, or what's the direction of the market, and eventually they can make some decisions based on that information. So again, I'm not gonna just try to force any point of view on your end. I'm just gonna show how to use the following calculators, and then you can convince yourself whether using technical analysis is good or isn't good for making, in this particular case, long-term investment decisions. First, we're going to load the data. The data is going to be in an Excel file, as usually we've done through this course. We're going to have data for 6 ETFs: SPDR, the Russell 2000, Europe, Asia, and Far East, the emerging markets, the 20-year plus Treasury ETF, and the Dow Jones real estate US market. And the data sample is daily sample, going from the first trading day 2004 to the first trading day of May in 2014. So here we have to click, as we're used to doing, our icon, and with these the data will come in. So let's start using moving averages, essentially comparing the index versus a moving average of 50 days, or 200 days, or comparing the moving averages between themselves. So let's look at what we have here. We have a panel that has on the right hand side a menu. With this menu, we will pick and choose what kind of ETF we want to work with. Then what criterion we will use for developing a strategy, either using or comparing the SMA 50 with the SMA 200, or the index versus the moving average of 50 days, or the index versus the moving average 200 days. We can see the moving averages. There is the dotted lines here. We can show and hide our index as we please. So, and on this left-hand side, what we have is strategy. We call it short strategy. Would be the beta that we will choose when the market shows a sell signal. Notice that that doesn't necessarily mean that beta will be negative. We are only saying the beta will be less than 1. So we can just reduce the overall exposure to portfolio by having more cash or adding some inverse ETFs. And the same thing on the long side. The long side would be our behavior when we have a buy signal. So let's just start in the trivial case where beta long and beta short are 1. So not surprisingly, the index and the strategy will look exactly the same, because what we are doing is just staying long only. Now, let's start comparing. Let's say that we compare the SMA 50 with SMA 200, and we will buy whenever the SMA 50 is above the SMA 200, and we will sell, or let's say go short, in our relaxed definition, when the SMA 50 is below the SMA 200. So let's start seeing what means to be short and what means to be long. Let's just lever the portfolio 2 times, or almost 2 times, and here what we see is that we end up getting significant returns, but the volatility of the strategy is quite big. I mean, this is very uncomfortable. We went from 200 to 100 during the contraction of 2008. That's pretty spectacular and brutal. So let's say if we had short the market just a little bit, I mean, just going a little bit more neutral. Wow, this looks much better. And let's just short the market a little bit more. Wow. So in the end, apparently, by using an S&P 500 as the benchmark and the index, and comparing SMA 50 and SMA 200 with a short of about less than a half and a long of about 2.0, we will end up having returns of about almost 600, which is 3 times as much as the plain index. Here will be the distribution of the spider S&P 500 versus the benchmark. And this chart is very interesting because it shows us the false trades. False trade is when this is a 1 and the right trade when it's a 0. And false trade essentially means having the wrong sign for the beta. So if the market is going down and a beta is positive, that would be a false trade, and vice versa. This is a 19% false trade, which is kind of high. So we could try to play differently in order to reduce that exposure. Now, let me show that this doesn't necessarily work equally well for other indexes, because let's say using exactly the same strategy for emerging markets, just not changing anything, the same beta, the same beta short, beta long, and wow, we see exactly what we don't want: enormous volatility, and we end up with a long-term return below the one of the long-only position. It seems to be the case that SMAs are not the ideal indicators for this. So we're going to have other technical signals like Bollinger Bands, Relative Strength Index, but I'm going to use MACD, which is usually recommended for indexes that have very high volatility. The parameters of the MACD model are essentially a couple of oscillators, what is known as the fast exponential moving average, the slow exponential moving average. With that, we create an index, and then, which is an MACD index, and then once the MACD is calculated, then another moving average is calculated in order to obtain the final signal. I'm going to leave you to read the information here in order to fully understand what the methodology is. But let's just see how we can make money in emerging markets when the SMA approach didn't work. So, as I said, I need to load packages and data. Don't never forget doing that. It's very, very important because the algorithms are loaded here, and everything needs to be nice and ready. So we have here our emerging markets. We can just start, as always, with betas equal to 1 in both cases. So with this, we will have very fast, very short intervals for the fast EMA, and go beyond 90 for the slow EMA. So with that information, we can start playing with our strategy. Let's just go a little bit short, neutral, let's say, and lever the portfolio on the long side. This looks pretty neat. Here is a huge false signal, but nevertheless, I mean, if we compare the returns, it's 5 times as much as we would have gotten without using technical analysis. Let's just see what happens if we get really greedy and short more. Well, there is also here the volatility, and the final return is not as big. So not necessarily shorting aggressively the market is the best idea, and not necessarily also levering the market all the way. So I'm going to leave it to you to try to find the best calibration of the model. Let's take a look at how the distribution looks like and the false signals. We ended up with not very many. It's less than 1% of false trades, which is quite impressive. And well, obviously, there are other tools like the Fibonacci numbers that are here. We have some interesting math that has to do with Fibonacci spirals and other interesting tools that are used for modeling what is known as Fibonacci retracements, or the definition of some levels of support and resistance. So this is a very interesting section. I'm going to leave it to you. Play around with it and try to find if you can actually beat the market, and what kind of technical tool makes sense or doesn't make sense to you. Thank you very much.